I just did a listing of the FANGs, and Facebook off 4%, Amazon down 5%, Netflix down 8%, and Google down 4%. So they're doing worse this morning than the broader averages. The FANGs being that kind of acronym people are using to highlight the lack of breadth in the market. Diana Avigdor, Vice President, Portfolio Manager, and Head of Trading at Barometer Capital. You're always looking at breadth. We'll talk a little bit about that in a minute. But a day like today, kind of follow on from Thursday, too, when we had a sloppy close. So what are your thoughts about this action here today?
You know, China being down 7%, I always have to scratch my head, as a matter of fact, when I woke up this morning and said, why? You know, the economic data was not so great, but it's not like it was a surprise. Trading desks are, of course, talking about that insider selling that has been, it has been halted. Anybody that owns over 5% of certain stocks, Chinese government has halted them, not allowing them to sell, and that is coming due on January 8th. But then I scratch my head again going, you know, we knew this last Thursday. So I don't put too much into the 7% China. I think that looking into first quarter, and particularly in January, we're going to see higher volatility than normal, in my view. I think December and fourth quarter in general last year was pretty sloppy and has made investors very skittish. And not that much is priced into the stocks as you know, because of the volatility and a lot of landmines, a lot of it has not been priced into the stock. So I think that when earnings season starts, we're going to have big tails of movements. And, you know, you're seeing that this morning with the FANG trade down. And I'm not sure what is up.
Golds.
Pardon me?
Golds. Yeah.
That's it. You know, it's the only shore that is, it's the closest shore that you can sail to in this volatility. There's nowhere else to hide, really, so it's by default up, really.
When you look at things we mentioned on the Chinese data, it wasn't that all of a sudden that economy started to contract. There are these trading issues that might be affecting the market, but I guess it's the same with a lot of things. So the consensus call to me this year is for heightened volatility, and I see that everywhere. Every last strategy report I read, be prepared for more volatility. The consensus can be right, but oftentimes the consensus is wrong.
But you know, this is the year of revelation, and there's nothing religious about this. This is about the year that we're going to decide and see whether we're going into some kind of growth or not. And the bond market and the yield curve truly is not showing belief that we're in a growth in the U.S. Resulting from the quarter point increase. So I think that is a binary outcome, because that is the risk in the market, is what happens to the bond market and what happens to the economic data and whether we are in growth or recession. So the volatility, in my view, from a consensus perspective, in this case, is called for. We have a binary outcome year. And to that end, we're going to continue having these, you have low breadth, like you mentioned, and you have major sector rotations that are happening on a quarterly basis. Used to be that, you know, something was up 10% a year. Now you have things rotating to the tune of 10% up and down in 3 months. I think we see that in the first quarter. I think January will set the tone from an earnings perspective. You also have companies that are going to give you their 2016 outlooks. And given this binary outcome economically, people are going to try and extrapolate from their 2016 outlooks what it means for the economy and where this is going. So we've had a binary outcome and big volatility last year as well, both in terms of performance and in terms of sectors, but the VIX didn't show it.
Right. Right. I did a number of looking at charts over the weekend, and I found it interesting looking at stocks that may be set to outperform versus those that aren't. And I found a kind of a juxtaposition between defensive names, like things like Coke. People are coming to me and talking about Coke or J&J, and then some real deep cyclicals.
Yeah.
And in Canada, the banks. Yeah. People are worried about the banks in Canada, but some of them look like they're set to outperform in 2016.
But it's also what the option is. right?
Yeah,
You know,
not many
right?
of
What's
them.
the option? So do you have to believe in the oil trade? And frankly, you know, we'd all love for oil to stabilize and rally, because Canadian market is so dependent on it in terms of performance. But with so many wars going on out there, why isn't it higher than $37? Also, you know, you could have a rally in the oil, but what's happening to the actual stocks?
And they've outperformed oil here recently, certainly over the last couple of months, pretty substantially.
Been some short covering as well, quite a lot of short covering, and tax loss selling and short covering your shorts and all that kind of goes hand in hand. But to your point about the interesting things that go on, the utilities in the U.S., for example, you know, they've done very well. The theme there is, you know, why is a utility going up when rates are moving up? You know, that's a head scratcher. Well, you know, people are looking for yield, and so you know, that is the secure yield trade. So a lot of different things that certainly. And the banks, our banks too. What, for 2-3 years, the world is waiting for the major housing crash. It hasn't happened yet.
We're still
Hopefully
waiting.
It doesn't happen this
When
year.
you look at all the trade going across your desk over at Barometer and thinking about where people are positioned, how are they positioned for 2016? Do you see any kind of sense of where people want to go?
We don't, you know, you don't see any major differentials overnight because the year has changed.
That's true.
Right?
I don't feel any different.
No, it's just, but, you know, people have a feeling, I guess there is, from a trading shorter term perspective, there's a feeling that when the beginning of the year hits, there is a long time to be wrong and fix it. So there is a bigger boldness in, say, you know, buying that oil stock, saying, oh, what if I'm picking the bottom now, and if I'm wrong, I got 4 quarters to fix it, right? So you see the oil trade going on right now, plus there is, you know, the geopolitical. So you have a boldness in trying out what hasn't worked, because everybody loves to pick bottoms. That's not what we do. We go with strength, as you know. But from a trading perspective, people love to try and pick bottoms and rotate out of what's worked. But you know, in terms of the oil trade, I might just mention that for us, the defense trade is a better play on the geopolitical risk. We have a large exposure to the defense sector in the U.S. You know, you have, higher budget, defense budget, great cash flows, great balance sheet. Defense budget cycles are about 10 years. They've stopped declining now with all the geopolitical issues that are going on. A healthy competition, but not too much, and developments on the IT side that they just can't talk about.
So that may be where to do our homework.
That is your geopolitical trade, perhaps.
Okay, thank you very much, Diane Avigdor. She's from Barometer Capital Management, head of trading there.